Now let's run another complex tax question through TaxMemory.ai and see how it handles something with a little more nuance. This one is not just a simple yes or no question. There are a few moving parts, and the answer depends on how the facts are treated. So we'll open up a new chat, paste in the scenario, and see if TaxMemory.ai can break it down clearly, pull the right authority, and give us practical next steps we could actually use with a client. Here's the question. For a 2025 MFJ client with $47,000 of state taxes and $620,000 MAGI, how does the new SALT cap phase-down work? And does S-Corp PTE tax paid at the entity level avoid Schedule A? This was actually a bit of a trick question, and because TaxMemory.ai double-checks against current up-to-date authority, it ended up answering correctly by saying, there is no enacted new SALT cap phase-down for 2025 under current federal law. For 2025, the rule we already know continues to apply. For married filing jointly, the total state and local tax deduction on Schedule A is capped at $10,000. So if your client has $47,000 of state taxes, they still only get a $10,000 SALT itemized deduction on Schedule A. Their MAGI of $620,000 does not change that cap. There is no AGI-based phase-out or phase-down of the SALT cap under current law, and the old P's limitation is suspended through 2025. If Congress later passes a 2025 change with a higher cap or a new phase-down, that would be new law. But as of now, that has not happened. Some articles are discussing proposals for 2025, which is probably what you are hearing about. On the PTE side, a properly elected S-Corp pass-through entity tax that is imposed on and paid by the entity is deducted on the S-Corp return as a business tax expense. It does not go on the shareholder's Schedule A, so it is not subject to the $10,000 SALT cap. Instead, it reduces the pass-through income, which can also reduce QBI and the Section 199A deduction, but it does bypass the individual SALT cap. So from a planning perspective, under current 2025 law, your married filing jointly client's $47,000 of personal SALT is capped at $10,000 on Schedule A, but a properly structured S-Corp PTE tax paid at the entity level can avoid Schedule A and the SALT cap, as long as it follows that state's PTE election rules. If we scroll back up, we can see the primary authority and citations TaxMemory.ai used to source the answer. This gives us a clear trail back to the actual rules instead of just a generic AI response. We also get secondary links and practitioner discussions around this exact topic, which is helpful if we want to go deeper, compare interpretations, or see how other tax professionals are thinking about the issue. So the answer is not just giving us a conclusion, it's showing us where the conclusion came from and giving us a path to research it further if needed. If we keep scrolling down, we get the action steps section, which gives us clear guidance on how to move forward with the client. In this case, it says, for current planning, model 2025 assuming a flat $10,000 SALT cap for married filing jointly, and ignore any phase-down chatter unless or until an actual law passes. If your client's state has a PTE regime, confirm that the S-Corp is eligible. Check the election timing, which is often due by the original return due date and sometimes earlier, and review how the credit to the shareholders works, including any state-level limitations. Then, model the trade-off between taking the PTE tax as an entity-level deduction that bypasses the SALT cap versus the impact of lower QBI and a potentially lower Section 199A deduction. Before filing the 2025 return, recheck Congress and IRS developments in case the SALT rules are changed retroactively or prospectively. And if we want to go further with any of these action steps or have TaxMemory.ai turn this into an email we can send to the client, we can just ask it to do that next. But for now, we'll stop this chat here. Overall, TaxMemory.ai did a great job handling the nuance of this trick question. It did not assume the law had changed, and it did not hallucinate an answer based on headlines or proposals. It went straight to the source, separated current law from possible future changes, and gave us the correct answer with clear guidance on what to do next.